Even before we get to what I'll call the mandate wave, we're seeing volumes grow as a result of ambient market conditions, balance sheet constraints, increased issuance, and so forth, that is really driving the adoption of central clearing by firms and increased amounts of volumes going into central clearing because central clearing provides unique economic value, balance sheet netting capabilities, capital relief, operational efficiencies. One of the unique aspects of the cash market, which is different than the derivatives markets, is we actually settle significant amounts of securities settlements every single day, and we net those down across our membership and across CUSIPs such that each of our members only delivers a single delivery or receive per CUSIP per day, and that generally brings operational efficiency to the tune of over 70% a day.
How ready is the industry for the US Treasury central clearing mandate?
I think we are making very good progress towards implementation. The best indication of that is the voluntary clearing volumes that we are seeing come into the Fixed Income Clearing Corporation. So just to give you a sense of context, when the SEC's Treasury clearing rule was originally proposed back in September of 2022, the Government Securities Division of FICC, which is the division that clears the Treasury activity, was clearing about 4.5 trillion a day. We just peaked on Monday of this week at 13.2 trillion of transactions, and 2.76 trillion of that total were buy-side transactions. And that's really what the clearing requirement is really focused on, is the dealer to client activity, certain of those Treasury cash and Treasury repo transactions needing to come into central clearing if they're not already there today. We have, long onboarding pipelines, and we have to date 150 total direct members in FICC. And we also have over 8,000 indirect participant relationships on our books to date. And what I mean by indirect participant is where a buy-side firm is using a clearing intermediary to come into central clearing and not coming in direct. We have over 8,000 of those relationships set up. Certainly, there's still work to do. One is there are certain outstanding issues. Some of those items include certain outstanding scope issues, such as inter-affiliate activity that is potentially covered by the clearing requirement, potentially reevaluating that. Another area where we're very focused is on cross-margining and bringing cross-margining down to the end user customer level. And we've had since 2004 a cross-margining arrangement with the CME group for futures positions of our common members that are cleared at CME and cash and repo positions that are cleared at FICC, being able to cross-margin those and give the margin efficiency of recognizing the offsets across the asset classes. We're looking to bring that down to the end user customer level. So that's also a big area of focus for the industry. The other area of focus is, quite candidly, the boring work of implementation, setting up the appropriate accounts, doing the connectivity, doing the testing, doing the legal documentation. And I would say more so for repo than for cash. We're, well on our way for the cash clearing requirement, in the sense that it's a smaller population of market participants that are impacted by the cash requirement. And we're also seeing steady growth in those volumes as well in the CCP. So today we are seeing on average around 180 billion of done away cash activity, meaning buy side activity being cleared through intermediaries at FICC, being processed every day. And we peaked on Liberation Day at over 350 billion. I think for repo, again, some of the scope questions are more relevant to that type of activity specifically. So I think there's a bit more uncertainty in that space, but certainly the volumes that we're seeing today and continue to see in voluntary clearing of repo activity are very encouraging.
What have been the lessons learned working with participants on implementation?
This market is so diverse, the Treasury market, that one size is not going to fit all. One access model is not going to fit all. And so we spent a significant amount of time over the course of 2024 and even before engaging with various types of market participants as to what they needed from a business and from a regulatory standpoint in order to make work implementing treasury clearing on a broader scale than is already happening in FICC today. So we spent a lot of time focusing on what access models they needed to see. And a really good example of innovation in this space is, based on the input, particularly from the derivatives community, the futures commission merchants and the asset managers that transact heavily in derivatives. We got the feedback that they wanted to see an access model that looked more like the FCM model in the derivative space. So we instituted it. We call it ACM, or Agent Clearing Service. And that model is really tailor-made to look and feel, from a rules perspective, from a legal perspective, very similar to the FCM style model in terms of sort of the relationship between the ACM in our rule and the clearinghouse, in terms of the relationship between the client and the ACM. We expect to see done away activity as we do today through that model, but also done with principal style activity as well. While folks, really appreciated us innovating in terms of bringing an FCM style model into the Treasury cash market, they also expressed some concern that there may be certain accounting conclusions that need to be buttoned up in order to ensure that FCMs, as an example, could use the ACM model and be able to get the appropriate off-sheet treatment for the activity that they're facilitating for their clients in the same way that they do for derivatives. So we spent, well over a year working with the accounting community, the SIFMA working group, and ultimately that resulted in a paper that SIFMA published regarding the accounting conclusions for the agent clearing model. And then also the SEC issued a confirming letter associated with that. So I think that's another area where we were really focused on making sure that our model was going to be fit for purpose and really very usable for the market for purposes of treasury clearing. The other item I would flag, you may have heard of the so-called double margining problem, which is really a focus area for cash investors in tri-party. The biggest group of these folks that we focus on, given the size of their volumes, are the US money market funds. Based on their sort of regulatory requirements, not SEC requirements for clearing agencies, but requirements applicable to them as 40 Act funds, they are required to be over collateralized, and so classically get a haircut on their cleared and bilateral repo activity. So that is a haircut that's typically provided by the borrower who borrows from them. Then in central clearing, because the clearinghouse, FICC, doesn't necessarily classically have access to the haircut or the purchase securities in general, then the CCP separately charges for margin, and that is separate. That's called the so-called double margining problem. So we have two access models that are currently in front of the SEC, formally filed, and we're looking forward to the decision of the SEC on both of them. One of them, which we call Collateral-in-Lieu, sponsor GC, we will be taking a targeted lien on the purchase securities of the cash investor, and that's going to obviate the need for margin collection in most instances, not all, but most instances, from the money market fund's intermediary sponsor. We're introducing a tri-party repo version of our agent clearing service. In that model, we'll be able to process tri-party repo as well as DVP repo activity. And that's going to be very important because that model has a net margin capability. So the exposure of the cash investor and the exposure of any collateral provider client can actually be offset for margining purposes at the CCP. And solving for the double margining problem in a different way.
How are you educating market participants outside the US on SEC clearing rules?
FICC has been a very global central counterparty for many years. We have direct members from 35 jurisdictions that we have approved in FICC. And for our sponsored member population, we have 51 jurisdictions approve. So we've been quite international for a very long time. I do agree there is, I would say, more readiness from a United States perspective than we're hearing and observing in other pockets of the world. And I think that there's two things to think about there. Number one, there are still some scope issues that remain outstanding that I think need to be addressed by the SEC, but there are some points of view on international platform activity, whether or not that activity should be subject to the clearing requirement. And there are also firms expressing views on whether international bank branch activity, so if the branch is not the CCP member itself, whether or not that Treasury repo activity should be scoped into the clearing requirements. So I think part of the challenge with the international community, some of them, right, is there's a lack of clarity. Which types of their activity are actually scoped into the clearing requirements? So resolution on those open issues that have been identified by the market is very welcome as soon as we can get it. The second point then is just continuing to do the outreach. I mean, we've done many road shows, webinars. We have usually somebody in Europe or Asia most months, right? Doing outreach, talking to clients, if they're not already there already, on what are their treasury clearing readiness plans. The intermediaries that are active in our voluntary clearing programs are also heavily engaged with their client bases around readiness. So I think that we have to continue to engage, educate, and again, lock down the scope so that everyone can then be focused on what their day one readiness plan is going to be.
What guidance would help firms achieve compliance by the deadlines?
If you think you have a build related to plumbing into one of the new access models or any sort of build implementation that you need to do with treasury clearing, you should be budgeted to do that in 2026 is my advice. I would not, even if it's only repo activity that could potentially be covered, I would not be waiting until 2027 to be doing any sort of build. I think 2027 should be focused on integration, testing, and go live. You cannot expect at this point that there will be a further extension of the deadlines. You need to be planning that the deadlines that are laid out by the SEC now will not move. So your planning has to incorporate that. And then the third piece of concrete advice that I would give is that there's no real harm in opening up more than one access model. If you have some clients that you think may want to stay in the sponsored product, and or you have other clients that may want to use the agent clearing model at FICC, for example, there's no harm in setting up multiple accounts and getting that connectivity ready now. You certainly don't have to use every account. You certainly don't have to take every account live at the same time, but having optionality in this fast-moving space is very important for market participants. Planning, preparing, and starting to get the accounts open that you need to be able to pivot, as the market may pivot around the implementation of this requirement.